Good evening, everyone. Welcome to the Hurley Investments Market View Commentary for Monday, the 8th of June. I look forward to being home. In all honesty, I just about fell asleep. My wife says, "Hey, if you just got here, don't fall asleep till after you do your class." So the answer, no, I got it, Lee. Thank you. All right, I've got a ton I want to go over. And part of it is because how the market in 2 weeks has changed so dramatically for a couple of positions that we're in. So it's pretty interesting because if I was going to take a look at the S&P, we're bullish but overbought. And all that I want to talk about is really looking at this pivot point at 3009 up to where we are today, which really I'm only interested in this 6%-ish move, right? Is it 6? Probably 7, closer to 7%. So I guess I'm more interested in that 7% move. That 7% move has changed a ton for portfolios. So today, let me go over the numbers behind the collar trade. That is what I hope to do. I hope to go through the numbers behind the collar trade, and then in all honesty, I'm going to go crash because I've been up since 12:30 this morning. I'll get this posted tomorrow, and I think it's going to answer a ton of questions for a lot of people. So let's go over collar trading numbers. Go over the collar trading numbers. And I've done this a million times, right? If your dollar loses 50% and gains 50% for a 0% average return, how much is that dollar worth? So this is the key, right? You start off with $1, loses 50%, so it becomes 50 cents, gains 50%, so it becomes 75 cents. It loses 25% of its value. So, because of this simple truth, this is why, and I'm going to say this with all due respect. No, I'm not. Let's be honest. I'm just going to call it what it is. This is why every single financial plan is 100% bullshit. There is not a financial plan that has ever been made that ever works. And it all comes down to trying to take the stock market as a linear return versus variable returns. So this is how people get their butts handed to them over and over again in funds. When you hear returns, percentage returns, It's all pie in the sky garbage. It's a joke. So years ago, I started putting together the collar trade, right? So let's look at the collar trade in general. You buy to open, long stock, can't type. You buy to open, long put for 2 to 3 months, and you sell to open a short call to pay for the long put. And usually those short calls have to be out there 6 to 9 months to make that work. Now, if we go through this, what are the problems? What are the problems? There you go, Lance. You've capped yourself to the upside. Correct. That is a problem. I agree. But I'm looking for an even bigger problem than that. What is the problem with the collar trade? Let's think about it. What's the problem to the collar trade? The standard way it's set up, or it's supposed to be set up. Expensive. In fact, there you go. And David, you hit it on the head here. Expensive. You have, in fact, and probably it's the same thing you were saying, Abraham. You have to spend more money or most of your profits to then pay for the next 1 to 2 earnings if you still want long put protection. You're hosed, right? So then as I was looking at this, and I'm a math guy, it came to me, you buy to open, long stock, you buy to open, long put, 2 to 3 months, right? And you sell to open, short call, 2 to 3 months. Now, this version means you will have some risk, which normally I want to put that risk somewhere between 1.5 to 4%. But the difference is if you have some risk, you have a greater potential for some profit. So I will start off, the short answer is, with new clientele, I usually start off with this format. Crying out loud, trying to book a profit. I'm tired. And then move the profits into leaps. I want to book a profit. You can book between a 7 and 13% return. I want to book that profit. I want to convert it into leaps. So now I'm playing with the house's money. Now, the key though, or the catch here, to make big money, i.e. beat the market, the collar trade works best with a first quarter, or the first time you use it, first quarter big downward movement. A swoosh to the downside, a failed earnings, a big move to the downside makes the collar trade work best. But traditional collar trading makes up 70%-ish to the downside and lowers your cost basis on the stock position, which isn't a bad thing, right? Which isn't a bad thing at all. If your stock goes from 100 down to 70, well, let's do 65. It loses 35% of its value, and you can make up 70% of that 35% on the way down. It means you're roughly going to be left with 9.5% loss. On that 35% drop, you only have to get back 9.5% of it, and you're profitable. Which means anything above 35, 9.5, anything above that 24.5% starts to become a profit for you as things come back. Not bad. It's a smart way to trade. In fact, in doing this, if you collar trade, you never miss an up day in the markets. But if you do it this way, there's some consequences. So really quickly, numbers. You buy a $100 stock, you spend $7 for long put, you sell to open $3 for a short call, and let's even put some real figures in here. At 100, short call at probably 115. Let's work your numbers, right? Get all this in here so you can work the numbers again. So the total cost basis is equal to 100 plus 7 minus 3 is equal to 104. Maximum profit 115 minus 104 equals about a 12%. Equal $12, and that's 12%. And normally right now you can be in that, 10 to 12% if you get lucky, right? The key to the collar trade is picking up more shares of stock. Giving yourself an explosive movement to the upside. And obviously you'd want to do it with 1,000 shares. So if you bought 1,000 shares at, let's do a manageable number. Let's do at $10 a share, right? Let's do 100. This will be $100,000, right? And let's work that through. $100K loses 10%. We can pick up 10% more shares of stock. And it's pretty simple on the way down. If we just keep taking this down, if it loses 20%, we can pick up 20%, 30, and we should be able to pick up 30. And then, just on down it goes. I'm going to stop at 50 because most of the time a stock doesn't lose 50% of its value. Unless you're Boeing, you lose 75%, right? So let's just take a simple understanding. If the stock is trading at $90 a share, and we have the long put that gives us the right to sell at 100K, right? Let's just do the math. Divided by 90, all of a sudden, when you take, I'm going to do it with a calculator, when you take $100,000, divide it by $90 a share, you can actually come up with 1,111. Shares of stock. Now what I would do is I'd pick up the 100 shares. That extra 11 shares I'm going to use to pay for my next round of puts. If it's 100 loses 20%, so let me just work these numbers in here too. And I'm just going to do the simple math because it's kind of fun to watch it add up, right? It goes to $80 a share. You then divide it by 80. $100,000 divided by 80. Now all of a sudden we've picked up 1,250 shares. If we go down to the $70 share range, $100,000 divided by 70. All of a sudden we're picking up not 30% more shares of stock, but we're picking up 428. Notice how it's getting even better as we're going down. It's because it's not linear. 100,000 divided by $60 a share. All of a sudden we can pick up 1,666 shares. And if we go down here to the bottom, $50 a share, all of a sudden we now have twice as many shares. Why is this so important? Why are these numbers so important? Why is it so important to pick up these shares of stock? Let's work these numbers back up the other way. That 1,100 shares of stock, when we start, is usually worth $96,000 because we lost that 4% when we sold off that long put. Usually we do it pretty close to at the money. If there is some time value in it, we're good to go. But if we get back to $100 a share, then we have 111K. And we basically just made, plain and simple, 11% on a stock that just broke even. Working it a little differently, 1250, right? Equals, it'll still be down that $4,000, so it'll only be equal to I lost 20%, so it's at 80, it'll be 76,000. Nope, 2080, yep, it'll be 76,000. But, in fact, I should just copy and paste this. If we get back to $100, then we have 125,000. And it could do this at the next earnings. If I keep going through, the math is pretty freaking amazing. If we pick up 1428, it's going to be only worth 40% drop there. So it's, where's my 30? I'm sorry, we got to do the 30 first. It'll only be worth 66,000. But if it gets back to 100, you're then going to have 142,800, 42.8% return. This is going to be 56, right? And it's just, the numbers are just staggering. It'll be 166,600. And last but not least, 2,000 shares is really going to be only worth 46,000 when it's down. But if we get back to $100, then we have 200K or 100% return. Why is it so important to add the shares? Right? Why is it so important? Why does it matter? Take that 50% again. If you just lower it by 50%, you're going to make $46,000, right? Why is it so important to add the shares? Loses 50K equals 46K profit for you, and then the 1,000 shares get back to 100. It equals 100K plus the 46K, and you'll end up with 146,000. That's if it loses 50%, which means if I add the shares and only loses 30%, I'm going to be equal to you. Or if you were to add the shares back in, you just gave up $54,000 to lower your cost basis. Let me say that one more time. You just gave up $54,000 to lower your cost basis. This is the key to collar trading. And again, we've had a 7% run the last couple days. I have portfolios that have gone from 755 to 902. I've had portfolios that have gone from 850 to 1,072. $1.1 million up to $1.5 million in the last 6 days. The reason why, because when you add those shares, the break even isn't the profit made on the way down. The break even is now exponentially closer because you've exponentially increased the recovery time. When you collar trade, you'll notice a huge quick recovery to portfolios. And it all comes down to adding shares. I was going to then go through the same thought on leaps. That really goes back to Wednesdays. And the whole thought process comes down to, if I get called out away, if I get called out immediately, I'm then going to be using the house's money. So plain and simple, when you work a little bit of the math here, if I can convert that profit to a stock replacement strategy with options, I have a much higher return on investment, and I have a lot less risk in your initial trading capital. I'm protecting the nest egg. Now, let's admit, the last 3 months have been a pisser. They have been difficult. But the whole idea behind the collar trade is surviving the market storms and allowing stocks to recover. I'll be honest with you, if I just watch my portfolio evaporate by 35%, I'm probably getting the hell out of Dodge, right? I'm cashing in that 25% down and I'm gone. Especially if I'm in a fund, especially if I'm just in a basket. Diversification. Oh, diversification protects you so much. BS. 96% of all funds, all people in the stock market don't beat the S&P 500 average. The reason why? Because diversification is what you do when you don't know what to do. You don't know what to do, you go throw it in the S&P 500 or an S&P 500 lookalike. Guess what never happens to your portfolio? You never beat the S&P 500 because 96% of the time the funds can't do it through diversification. 96% of the time you don't beat it. And if you do beat it, guess what? You've just paid anywhere from 3 to 7% to be in the fund, and you're paying your stockbroker 1% to manage your money. You don't ever stand a chance at coming anywhere close to meeting your financial plan, to having your money make any money, to have your money even beat inflation is not able to be done when you're in a fund. When you're in a traditional stockbroker's portfolio, you're screwed. You are not able to make any money. So I love where we sit right now. With that said, we've got to get a hold of the big picture, and let's understand what's happening right now. Hiring returns, but the labor market is not back yet. A great article that came out through briefing.com. We're nowhere close to being back. We're significantly better, but we are nowhere close to being back. And if I can just kind of make this in plain and simple, yes, we've had millions come back to the workforce. And those millions, for the most part, are not full-time yet. If they are full-time, they're not making what they used to, as they have to take some cutbacks as companies are trying to survive this coronavirus. And the revenue is in significantly lower than it was 3 to 4 months ago. Plain and simple. Technicals say we're overbought, and companies are not anywhere close to where they're going to need to be, especially for the next earnings release. Anyone know, when do we go through our next earnings? When do we hit our next earnings in general? July. Perfect. We're going to go through a July earnings where it's very, very likely that we will not have companies meeting their revenue, nowhere coming anywhere close. They just won't. And then if we think forward, September, October, November, elections will probably go through our coronavirus phase 2. Let's face it, we're going to be in for a bugger of a time. How cool is it to be excited for the next drop down? How cool is it to understand and to see? You know, most people tell you, oh, they're big swooshes down, and it takes a very long time to crawl back to be profitable. If you took a look at my recap, I'm excited because there's so many stocks that are still 10 to 20% off of their highs. And we've added 10 to 20 to 60 to, if you're in Boeing, 200% more shares of stock. Where we've been able to dollar cost average leaps 2, 3, 4 times. Really, go back and listen to last week's, it's supposed to be on Thursday. I pre-recorded it Wednesday night. Go back and listen to last Wednesday's understanding of leaps and why we don't buy long puts on the leaps, but we do dollar cost average. It all comes down to numbers. It all came down to numbers to see me, to help me understand, wow, a 20% drop, I can pick up 25% more shares of stock. A 30% drop, I can pick up 42.8% more shares of stock. A 40% drop, I can pick up 66.6% more shares of stock. A 50% drop, I can pick up 100% more shares of stock. Which means, again, if we have a 50% drop, my shares go down, my stock goes down to $50. My cost basis is 52. I now split that $4 between every stock. It's another stock. I split between those 4 stocks. Anything above $52, and I'm profitable on my stock. It's that simple. I'm going to allow you guys to ask some questions, but let me go through some information. The Dow, we're bullish, but overbought. We might stay overbought for another 2 weeks. As you look ahead, in 3 weeks, we get, not this week, not next week, but the week before 4th of July, we get some pretty interesting numbers that come through for GDP and, our average work week again. That'll be the big tell. S&P, same thing, bullish but overbought. We might be overbought for another couple weeks. NASDAQ, bullish, overbought, and at an all-time high. You guys want to hear something that pissed me off that I put someone in their place today? Or should I just hold that one to myself? Well, that's funny because I now have 3 of you. 1, 2, 3. Tell us. I had someone ask me today and basically came down and said, hey, why is my account not up to a all-time high, which some of you are, but why is my account not up to an all-time high like the NASDAQ? And I very politely said to someone that asked me that question that is here today, so Lance, I'm going to pick on you a little bit today. I very politely said, well, dummy, it's because you've basically held me accountable to the S&P 500. That is a broader index. It's what most money managers are held accountable to. So please don't change the game. Please don't change what you're going to hold a money manager accountable to. I got a good one in there on Lance. And Lance, I'm telling the watered down version as to not embarrass you. Simple. We're not there because our benchmark is not the NASDAQ. But Kevin, you trade in the NASDAQ. I do, because the last 12 years, the NASDAQ has outperformed the S&P 500. But the benchmark is still the S&P 500. Where will the S&P 500 end June? I'm going with 2.5%, but I would really like to say 8, because that would firmly put us above our gains for earlier in the year. Economic reports, we're probably going to be flat on Wednesday as we go through the FOMC rate decision. I really hope that Powell has understood that you don't say anything. The Fed is going to have our back. They're going to keep rates low for a ridiculous amount of time. It's It's pretty simple. It's pretty simple to understand. Not much will happen this week. Not much will happen next week, except for options expiration. Really, the big week is going to be going through June 22nd to June 26th. Existing and new home sales, it probably won't fare very well. GDP and durable goods, personal income, personal spending. We have a little 2-week buffer where we might sit tight. We have a little 2-week buffer where we can continue to go higher. Not a whole lot of earnings coming up. And I'm not even sure if that Lululemon is correct, but Adobe will be an interesting one to watch on Thursday. Internationally, we had the trade balance that came in on actually Sunday evening that pushed markets higher as China's trade balance was better than expected. Industrial production, Lagarde speech today, Euro GDP on Tuesday, China's CPI and PPI for inflation on Wednesday. Not a whole lot that we have to worry about there. I'm looking to trade. I am looking to let things run. We took profits on Facebook and we're paring down Boeing leap calls. And we're really getting stock positions. How do I put it this way? We are trying to enjoy the run up until July earnings. Can you imagine what a pisser you would be in if every 2 to 3 days when your stocks go up, you're rolling your puts higher? You're giving away your profits. The key to investing, protecting yourself to the downside and letting things recover, or sometimes, as you want to call it, running back to the upside. That is going to be the key. I found it interesting as that same individual talked to me about why I'm not at an all-time high. It was very simple to tell him, let me know when I'm going to be compared against the NASDAQ. I'm on board with that. But it's very helpful to understand what are the sectors and industries of the S&P 500. I'm shocked at what people do not understand. Definitely take some time going through the 11 sectors. Looking at communication services, what is in that sector? Consumer discretionary, it's a huge sector. Consumer staples, it's a huge sector. Energy, financials. Energy is going to be different than something else we're going to come up against. Healthcare, industrials, information technology, materials, real estate, and utilities are the last one. Energy and utilities are completely different. I would suggest, just for a refresher for some of you, make sure you go through your sectors so you learn what's in them. Another thing that's very interesting, take a look at the growth rates or the percentages. Completely off base. Averages are not your friends. No one in utilities has made 121% return in the last 10 years of utilities. It's just not there. Pretty amazing. Jim, let me answer that question in just a minute. The Fed finds new challenges for the economy, workers who don't want to come back to their jobs. A very interesting article with where paying so much out has made our lower end middle class, it's smarter for them to not be working. They can make more by not working. Bank of America is rising from the ashes. I didn't do a very good job of taking out some of the pictures and so forth, but a really good opportunity here to understand Bank of America. What a run we've had on Bank of America. A reason why we like it. It just verifies some things to Keeve and I. What an amazing opportunity we have for being in Bank of America right now. Probably, in my opinion, behind JP Morgan, even better than Goldman Sachs. This is where you have your growth opportunity. Why stocks will go higher even with massive unrest across America. Very interesting article that, again, gives the Fed quite a bit of credit. A pretty interesting article found on Baidu to understand just how much they beat their earnings and where they're sitting at, their revenue streams. Morgan Stanley says will not want to break the phase one deal with China. I would agree. Trump finally has China where we're not getting ripped off. We're probably going to do everything we can to hold that deal in place. 5 charts that track the U.S. economy amid reopening progress. Pretty interesting to see different area like using Apple Maps, restaurants, hotels, air travel, home purchases. Pretty interesting to see where our economies are growing. A really ridiculously stupid article on how we're going to provide more money. As I read through it, someone said we're all going to get $10,000 a month more if a Senate proposal passes. It's unbelievable how people don't understand supply and demand. If you flood the market with cash, inevitably that cash is worth less because there's no demand for it because everyone has it. And what goes higher? Inflation. If everyone's making $10,000 a month, do you know how much toilet paper would cost? Yeah, like $500, right? This is the big problem with what do they call it? The minimum earnings. If you have a minimum earnings for everyone where no one can make less than 100 grand a year, it sets off inflation like there's no tomorrow. Just because everyone can make 120 grand a year does not benefit the pricing, and all of a sudden capital markets readjust, and before you know it, we no longer have that opportunity to buy that motorcycle for 10 grand because all of a sudden inflation shoots up and that motorcycle becomes just as expensive as it was when we were making 40 grand. So the thought process of, hey, everyone will make all this amount of money and things will just keep going. In all reality, you'll see huge inflation here and we'll outprice ourselves for the market currencies that are out there where no one will buy our stuff because it's too dang expensive. Now, I'm going to open it up for questions. And I had a question came in that was pretty interesting. There are a couple of you that fit in this situation. When I first got $2.5 or $3.5 million at the beginning of the year, for a lot of those people, I only put 40 to 60% of their money to work. Most of them are up 8 to 9% for the year now, right? 500,000 sits between $540,000 and $550,000. So an initial staunch of cash came in and things were a little scary. So there wasn't a clear indication to me, but I had to go put all their money to work. So I didn't. Now it's interesting because Again, that group right now has about 40% of their portfolio in cash. And I've got a couple things I'm looking at, but right now there's not a whole lot that looks attractive. What really looks attractive is oils or energy, materials or industrials, and the services industry. I wouldn't want to be in any of those. We don't know the rules of social distancing. You won't see people working like they used to in the industrials. There's no catalyst for oil. Oil could stay low for the next decade with having oil at $25 a barrel, all because 3 or 4 other countries broke OPEC and became net exporters of oil. What was my third one? I'm tired. I can't see putting it into whatever my third one was there that I just forgot. So, just the same way, because we didn't rush to get some of our stuff in, we're also not going to rush to get it in right now as well. We're going to find some undervalued positions. Probably in retail might do pretty well between now and the end of the year, and in some financials to get some more of that money put in. But the next expectations will probably start our hit or our leveling off in July. I tell you, September, October, November, probably going to be pretty ugly. Probably be through COVID number 2, second season, and we now have some reference points on how far our markets can fall again. The services industry, thank you, Ida. When we can't work like we used to, being close to people and so forth, I don't see a lot of help in the services industry. It doesn't look good either. So some of the beat up areas, I'm not interested in going in. Healthcare. Healthcare should have done fabulous. But because we were so scared for kind of a bad flu, all their profit got taken away from them so they could be ready for this pandemic. This huge rush on the hospitals. They got crushed. Absolutely crushed. I usually don't like healthcare because there's no money in a hospital. I really don't like biopharma because, in all honesty, why would you trade the news? The news is like the weather. When you can't predict it worth a darn, what patterns are you looking for? There are no patterns for news. It's variable. It's variable without a time frame to put it in. What other questions do you guys have? So let me go back, and actually that's interesting. So Kevin, what would you do if new money came to you today? I would go back to those core positions. We still have a run in Disney. So I'd put upwards to 15% into Disney. We still have a run on Visa up to 228. I'd look at Visa. I'd look to get into some Under Armour, which has run up to $28, sitting at $11.40-60. I would just replicate if new money were to come in. I would replicate the core holdings portfolio that we're currently in, and I would get them ready for a little bump up, and then we're back to those highs for, again, probably a swoosh down for elections and so forth. Boeing. Why is Boeing coming back so much? Great question, Lance. I think Boeing came down to their debt offering. I also think it came down to, and I finally, Keeve actually pushed me onto it on CNBC. An analyst on TV said these guys have 9.5 years of a backlog. You know, they lost 1.5% of their net revenue. When Boeing had their debt offering, it was 2.5 times oversubscribed. They wanted 25 billion. 667.5 billion was coming their way. So in all honesty, Lance, Boeing went down too far too fast, and it's just recovering, to make a long story short. And yes, I knew you were going to ask that as a second question. Can you be overcautious? And the short answer is yes, you can. It's being protected. It's always being protected. It's rolling up your puts. You give away all your profit. We've done so well because I was cautious. We did well because we protected. We even overprotected. In fact, some of you could notice a couple weeks ago when Trump came down to China, we day traded puts on Disney. We lost $1 to protect Disney on like a $3 up day, just so we could be cautious and protect from Trump getting, you know, a hair in his craw and really putting it to China. So I would ask that don't ever punish me for being cautious. And don't punish yourself for being cautious. If you miss a run, you miss a stock, you miss a great prospect, you miss a trade, don't worry. It's stupid to measure yourself on a single trade, a week's results, a month results, a quarter's results, especially when you're looking at, you know, most of your trading for retirement. The stock market's never been an ATM machine. It hasn't. You want to put people to the test with these, you know, outrageous returns? Tell them to open up their portfolio. Prove it to them. Have them pop open what's going on, where you guys are at, what you're doing. Anyone can do it. A question came in. Which do you think is the weak side of the leap strategy? The weak side of the leap strategy is if you run out of time. If you run out of time and you're into the last 6 to 3 months before that expires, you've got to condense what money you have left, which means as we're looking at it for Boeing, we'd have to move from 24 contracts down to 3 contracts per person. And it would lower it from 350 down to January 2022 down to like $330 or $320. But it would buy us an extra year. So the weak side of the leap strategy, even if you're using the house's money are still your profits. It is keeping your nest egg, your initial invested capital protected, but it's still your profits. And sometimes stocks don't move in a 2-year period of time. They don't move enough. So you have to be able to have some cash on the side to dollar cost average. So So another great question. It's kind of funny because Dave, there's another individual here that's also asking the same thing, and we talked about it. Yes, Dave, I would like to move over as much as you're comfortable with into Hurley Investments. The sooner you do it, the sooner you get these type of returns instead of just breaking even. No one wants to just break even in the stock market. So yes, I would much rather have funds now that are back to break evens versus being down 35% and then handing it to me. If I can't make some of that downside movement, you take a hit in there and then you give it to me. It might be disappointing because I'm protecting on the way back up. It depends on the cycle. So ideally, yes, David, right now would be an opportune time because you're flat to down 2 to 5% on your funds, and it's a more level playing field for me. So the short answer is yes. Today would be ideal. Getting you into taking a peek at some things, getting you into well, Apple's a little big one. Let's go with Baidu, right? Baidu at 117. Apple's kind of rich at 333 right now. Boeing at 230 has 400 to get to. Baidu at 117 has 288 to get up to. Costco's pretty rich. Disney at 127. Really? Wow. Disney at 127 has to 155 to get up to. There's definitely some room there. Ford has up to $10 to get to. FCX at 1125 can get up to 42. Facebook's rich, it's its high. General Electric could get up to 15. It's at $8.46. Key Corp up to 40. JP Morgan up to 160. Bank of America up to 35. I missed that one. Don't know where Target. Under Armour up to 28. Visa up to 228. So yes, there's still plenty that I'm going to mimic for some core strategies. But when I just went through all those, there's still significant upside available in these positions. And the neat thing is, coming up to the next earnings, which we probably think is going to be kind of a bugger, new money gets the full collar trade put on it. I could do the same thing for stock that's at the all-time high, but new money usually always gets the full collar trade. So if it goes down, there's less of a loss for that period of time. Are there any other questions? I know we're kind of going over an hour. It's been a busy day, but I hope this is helpful. In fact, is this helpful for you guys to better understand the whole process of collar trading? Has this been a eye-opening, or has it been helpful for you? Right on. I just saw 3 yeses come in immediately. And it's funny, Jim, Dave, and David. Yes, all 3 of you are probably thinking the same question. Well, if you don't have some of my money invested right now, why would you put new money to work? Each account is separate. Each account has its own right and innate ability to make as much as it can. And I work with a core group of stocks. I spend the whole 2 weeks during Christmas crunching numbers and studying my guts out. Really pretty good and pretty helpful. All right. Any other questions I can answer? I know we've got a little bit late. This will not get posted till tomorrow morning. I'm literally, when we call it quits, I'm going to go crash. I've been driving since, geez, who knows? Been up since 12:30 last night. All right, hey, you guys have a wonderful evening. I appreciate your time. Jim, I will work on giving you a call again, most likely tomorrow, early evening. Same with you, Dave and David. Let's just keep our Thursday morning appointment ready to go. Guys, have a wonderful evening. My pleasure being with you tonight. Let's look to see what our market brings us again. Have a good evening. I'll see you tomorrow evening for the trade findings and adjustments. Good night.